Here's the nuts and bolts of real estate loan payments, broken down like a payment ladder, so it finally clicks. Step 1 on the ladder, interest. Each month, the lender computes interest on your remaining balance, usually using a daily rate. On a standard amortizing loan, interest gets paid first. Step 2, principal. Whatever remains from your payment after interest chips away at the balance. Early on, most goes to interest. Later that flips. The magic of amortization. Step 3, escrow. Part of your payment collects property taxes and part collects homeowners insurance. Think of it as a savings bucket your lender manages. If those costs change, escrow adjusts and your total payment can jump. Step 4, mortgage insurance. Put less than 20% down. You'll likely see PMI on conventional loans, or MIP on some FHA loans. PMI can drop off around 20% equity. For some FHA loans it sticks around longer. Fees sit on a side rung, late fees, servicing fees, HOA pass-throughs. These usually don't reduce your principal, and if you miss payments, money often goes to fees first, then interest, then principal, so falling behind can snowball. Now the power move, extra payments. To speed payoff and crush interest, mark extra dollars apply to principal. If you don't specify, a servicer might push it to future payments or escrow. Bi-weekly versus monthly. Bi-weekly means half a payment every 2 weeks, 26 halves. That's 13 full payments a year, 1 extra. It can shave years in interest, but only if it's applied to principal. Otherwise, make 1 extra principal payment yearly. Fixed versus ARM. Fixed rate loans keep your interest rate steady. ARMs adjust after an intro period based on an index plus a margin, with caps limiting how much payments can rise or fall. The latter order still applies, but after a reset, your interest rung can grow. Plan ahead for adjustments. Prepayment penalties. If your note includes one, it sits above principal during the penalty window. Always check the fine print before refinancing or selling. Negative amortization. Avoid this rung. If your payment doesn't cover interest, unpaid interest gets added to the balance. Your loan grows. That's like climbing down while trying to go up. Delinquency and forbearance. When you miss payments, money gets routed to fees and interest first. The clock keeps ticking. With approved forbearance, you might pause payments, but interest can still accrue and be tacked on later. Know how amounts capitalize when it ends. Quick checklist for winning the ladder. Auto pay on time every time. Label extra as principal only. Do 1 extra full payment per year or bi-weekly correctly. Track escrow changes. Taxes and insurance drive surprises. Revisit PMI or MIP when you reach the equity threshold. Watch for prepayment penalties. Confirm how extras are applied. Bottom line, understand the ladder and your dollars climb faster. You don't need luck, just the right order of operations. Set it, label it, and let compounding in reverse do the heavy lifting.